Have you ever wondered what the real difference between index funds, mutual funds, and ETFs really are? Choosing the wrong one could cost you thousands in unnecessary fees, and you may not even know it. In this video, I'll break down exactly what you need to know to avoid that mistake and make sure your money is working for you, not against you. Stick around to the end because I'll let you know which option will save you years of hassle and skyrocket your long-term gains. We'll be diving into the key differences between index funds, mutual funds, and ETFs. These are terms that are often used interchangeably, but can make a huge difference in your investing strategy. When I first started investing, I didn't know the difference either. But by the end of this video, you'll not only understand the difference between these funds, but also get my take on which one is the best option for your investment portfolio. So let's jump right in by talking about what these three types of funds have in common. First off, all three let you own a small percentage of many underlying assets with just one transaction. Think of it like buying a candy jar filled with Skittles. Each Skittle represents a different stock or investment. Instead of buying one single Skittle, you're getting a small piece of the whole jar. This is convenient and gives you instant diversification, which helps spread your risk across a wide range of investments. Now let's move on to what sets them apart, starting with mutual funds. A mutual fund typically consists of 40 to 100 stocks, but is actively managed by a professional portfolio manager. This means a stock manager decides which stocks go in or out of the fund. This is far better than managing it on your own, as they will spend all their time looking at stocks and determining what's best for the fund. And since they get a higher commission, the more money that is invested in the fund, they are incentivized to do the best job possible. According to the SEC, paying just 1% in fees annually can reduce your portfolio value by over $30,000 compared to funds with lower fees. For this particular reason, I'm not too big a fan of mutual funds. They slowly eat into your returns over time, and you can find similar investments with much lower fees that will achieve a much better return in the long run. Next up, we have index funds. These funds are passively managed, meaning there's no portfolio manager making decisions on your behalf to decide which stocks go in or out of the investment portfolio. Instead, the fund simply tracks the performance of a specific market index, like the S&P 500 or the FTSE 100 in the UK markets. Since there's no active management, you can expect the fees to be much lower, sometimes reaching as low as 0.04%. And here's the best part. Studies show index funds often outperform actively managed funds over the long run. Warren Buffett himself even placed a $1 million bet in 2007 that an index fund would beat a hedge fund over a 10-year span, and he won the bet in the end. Another great reason to go with index funds is that it's a set it and forget it type of investment, where you can put money into the fund and not look at it. You can also be confident that it'll grow over a long period of time, since the markets have typically shown to grow on average by 8 to 10% every year. So overall, index funds track the market and typically charge way less in fees than mutual funds, which is great for the average investor. Finally, we have ETFs, which stand for exchange-traded funds. They can be structured to track anything from the price of a commodity to a large and diverse collection of securities. But the main difference is you can buy and sell them like stocks throughout the day. They can even be designed to track specific investment strategies. Different types of ETFs are available to investors for targets such as income generation, speculation, price increases, and to hedge or partly offset risk in an investor's portfolio. This gives you more control, but you'll pay commissions unless you use a platform like Robinhood, which offers zero commission trades. Overall, they are great if you want flexibility and the ability to trade throughout the day. And with fractional shares now available, you can even buy into an ETF with less money than it would take to invest in an index fund, which often has a higher minimum investment amount. And so, which one should you go with? If you've been following along, you probably noticed by now. I'm not a fan of mutual funds due to the high fees they come with, especially compared to the other two options. Now, if you prefer flexibility or have a smaller budget, ETFs are a solid choice to go for. But for most investors, I'd always recommend investing in index funds because they're low maintenance, which will save you lots of time and stress. They also offer great long-term returns, as proven over decades of growth in the market. And lastly, they charge the lowest fees, which means you'll be able to keep most of your earnings and grow your portfolio. In any case, always watch out for those fees and make sure you understand what you're getting into when investing in any of these 3 investment options. If you found this video helpful, don't forget to like and subscribe for more investing tips. And do leave a comment below to let me know if you're investing in any of these 3 investment choices, and if they've been successful for you at all. Other than that, thanks for watching, and I'll see you on the next one.